Hi, this is Michael Yardney and welcome to my property update. It's official. We now know what Australia's best economic boffins think is going to happen to our property markets and our housing markets. Currently there are lots of mixed messages out there, some very negative and others suggesting early signs that the worst is over. Now these mixed messages don't really surprise me. We tend to get this at turning points in the economic or property cycle. To help me decipher the clutter of all the mixed messages though, I find I'm really selective in which economists I listen to. Now I know no one's 100% right, especially with forward forecasts, but I was heartened by a number of recent reports from the Reserve Bank of Australia, which I'd like to briefly discuss in this market update. Last week, Reserve Bank Governor Glenn Stevens said Australia is in a great position to take part in a global recovery, which he expects to see get underway towards the end of this year. However, he said that when the recovery does come, it would be slow. He reinforced the budget's positive assessment of Australia's recovery prospects, predicting that the nation would come out of this period of global economic crisis in a much better shape than most other developed countries. The implications that Australia is well positioned for a pickup next year means that we should not expect many more significant interest rate cuts. But the Governor did leave open the possibility of a few more cuts of maybe 0.25% each. Now I can see how this could be a tactic the Reserve Bank could use later this year, dropping interest rates a bit to help boost consumer confidence if needed. Then the same week, Dr. Ken Henry from Treasury also confirmed the forecasts that our economy is going to grow strongly. And he backed up his comments with a whole new set of numbers about population growth, participation rates, productivity, that underscored the budget's estimates of 4.5% growth after the recession. Now it makes sense that after a number of years of below average growth, that our economy will pick up and have some above average growth. That's how averages work. Earlier this month in the Reserve Bank's statement on monetary policy, the Reserve Bank concluded that after falling modestly in 2008, nationwide house prices have changed very little in 2009. Now they did recognise that in the most expensive suburbs prices fell significantly, but prices in the other suburbs, and in particular the least expensive suburbs, have actually been rising a little bit in 2009. On the outlook for housing, the Reserve Bank commented, looking ahead, low mortgage interest rates and the increasing grants for first home buyers have made home purchase more affordable. There are positive signs in our forward-looking indicators from the bank's business liaison. But as already mentioned, there are mixed messages in the media. Still, several economists are warning us that we could be facing much tougher times ahead. Morgan Stanley's Gerald Minack has been a property doomsayer for quite a while, and he's still predicting property prices are going to fall up to 30%. He concedes that while supply and demand pressures would normally hold up property values, and that currently there's an increasing demand from an increasing population and a shortage of his concern seems to be that one of the factors that drove up property values over the last years was the willingness and the ability of consumers to leverage up. And he says that that willingness and ability will be sorely tested. He's obviously concerned that tighter credit conditions will put a damper on our property markets. Now, if you've been following my regular property market updates by now, you'd know that I have the opposite view. I have very strong positive views on the property markets in most of our capital cities in the medium to long term. This is based on the fact that we've got an increasing population and changing demographics, with fewer people in each household, creating a strong demand for the limited supply of properties available. Plus, I recognise that the new properties that will need to be built will be much more expensive, thereby holding up prices of established properties. Sure, I understand how the banking and credit environments have changed dramatically over the last few years, but our banks are cashed up and in sound condition, and they're willing to lend to homeowners and investors who are creditworthy and can service their loans. In fact, some are still prepared to lend up to 90% of the value of the property being purchased. What we don't have any longer is the ability to borrow money without proof of being able to service loans, like occurred in the boom times of no-doc loans. Now, I'm not concerned about this. I see it as a good thing. It'll stop some investors and homeowners overcommitting and getting themselves in trouble. I'm also very aware that while there are early signs that the worst may be over, there is still more pain to come, especially with increasing unemployment and more business failures. And I realise that unemployment is a trailing indicator. it happens at the end of a recession, and that the share market and property markets are a leading indicator. They anticipate business and consumer confidence, and they start turning upwards before some of the other statistics confirm the moves. So what's holding back property markets? Really, one significant factor is consumer confidence. But this is beginning to change, especially in the first homeowner arena. I know at Metropole we're definitely seeing more and more investors wanting to get in before the market changes. If the Reserve Bank is correct and Australia pulls itself out of recession later this year or early next year, partly with the help of China, people are going to regain their confidence and start looking for a safe place to park their money. Some will put their money into the share market. In fact, many already have, and they've pushed up the share market 20% or so in the last few months. Others will look for a safe haven. After downturns, there's usually a flight to quality. Many will put their money into quality property. As the markets turn, people will be loath to speculate. So they'll avoid the latest investment schemes, like those failed forestry schemes, and they're going to tend to avoid speculative property investments. They'll head to the security of property, something they understand, and in particular, property in proven locations in areas that have had a long-term history of capital growth. The sort of areas that I've been recommending over the last few years. Now, I'm certainly aware of potential short-term problems related to the credit crisis and poor market sentiment, which means that while there are some great property opportunities out there, you should only be looking for property at the right price, in the right location, with the right rental income, and with the potential to add value. You see, I expect continued sluggishness in property values over the next year or so, but I don't expect significant further falls because of the low interest rates and increasing affordability as they work their way through the markets. What that means is there are some great property opportunities out there for investors to get set for the next property cycle, but you just can't buy any property. You've got to do your research right, you've got to get it right. Now, in these changing times, like we're experiencing, there's no one who can help you get some of that information and research right, like the award-winning team of property strategists at Metropole. And by the way, we help homeowners too, not just investors. Remember, we have no properties to sell, but access to every property on the market. So if you'd like to find out a little bit more about what our research is suggesting is going to happen in your local area, come along to one of our free property briefings that we hold in our boardroom in Melbourne, Brisbane and Sydney. Just click on the link below and join us at one of our free briefings. Sometimes they're held on Saturdays, sometimes midweek. Also, if you like to thrive in these changing markets, while others are having difficulty just surviving, please check out my book, which has already become a runaway top seller, Thriving, Not Just Surviving in Changing Times. Please click on the link below to order your copy today.